You do not want to miss this episode. Unpacking corporate investment strategies, what every business owner needs to know. If you're a business owner out there, you heard about all these different levels of taxation. On my interest? What about dividends? What about capital gains? What about the new capital gains inclusion? What about this small business passive income grind? We're going to dig into all of that today. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina Wyatt. Christina, how you doing today?
Hi, Darren. I am doing great. How are you doing today?
I'm doing awesome.
I'm really excited to dig into this topic. I think there's a lot of corporate business owners out there that, want to invest in their corporation or are investing that might not be aware of some of the things that we're going to go through today. So I'm super pumped to talk about it. But before we get started, I do want to remind everybody, if you are listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, please like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All right. And Christina, I will add to that. We are not tax accountants, tax specialists, tax lawyers. We're just a couple business owners that have a fair amount of experience in this. And we're just sharing you what we know for education purposes only. Make sure you talk to your accountant about any tax strategy before you implement it. All righty. So we're going to get into corporate taxation, but I wanted to actually start with just personal taxation, a quick kind of summary for the listeners. And when it comes to personal investing, there's really two main choices. You can invest with registered money or non-registered money. And a registered money or registered program is basically a government sanctioned investment program, right? So your big ones in Canada, you've got the RRSPs, your tax-free savings account, TFSA, your RESPs, your education, your RDSP, the Registered Disability Savings Plan, and the new first-time homebuyer savings plan. So those are kind of registered money. And when you go into registered money, you're kind of limited on what you can invest in, but there's some perceived tax advantages. I don't know if all of them actually are tax advantages. A lot of tax deferment going on, and we like some better than others. So that's number one, registered. And then there's non-registered. And non-registered, there's kind of 3 or 4 different main types. There's interest income, there's capital gains, there's dividends, and then there's tax-free. Okay, so that's on a personal basis. So that's how people invest personally. But what about corporately? First of all, like, why do people invest corporately? Why doesn't everybody invest personally? Well, we invest corporately for a number of reasons. If you are an incorporated individual with an active business, in other words, you have an active business that you're producing goods or services and you're doing something active, there's some huge advantages to investing inside your corporation. Number one, there's tax advantages. You can really defer income, take it when you want, and then predominantly, number one, for a lot of people, there's creditor protection and limited liability when you incorporate. So there's some huge creditor protection opportunities. The tax advantages, huge estate planning advantages to investing inside your corporation. And then, of course, these 88-cent dollars that we're going to spend a lot of time thinking about. But when you invest inside of a corporation, all the money is non-registered, right? So all the money's non-registered, which is great for a business owner because that means we have maximum flexibility. We don't have someone telling us what we can and can't do inside that corporation when it comes to investments. We can do all the same things we can do personally. We can invest in interest-bearing stuff. We can have capital gains, buy stocks or mutual funds. We can have dividends. We can have that same tax-free advantage that individuals have in some of the products we're going to talk about. But then the other thing is this capital dividend account. And that is huge for business owners, a capital dividend account. And we're going to talk about how huge that is and why you want it. And then when you go to sell your corporation, there's a small business capital gains exclusion. So for the first $1.25 million, you're not going to pay any tax when you sell that. And then depending upon your structure, sometimes you could multiply that through family members. But those are kind of the key, what you typically see in investments. So let's dig into each one of those after we just kind of do a quick recap on this passive income, because this is one that a lot of people still don't really understand as business owners. And I promise you, for those that don't know it, the day of reckoning is sneaking up on you. And what I mean by that is few years ago, the government came out with passive investment rules inside a corporation where they basically said, if you're a business owner, we think you should only be able to make $50,000 a year from your investments. Like, think how crazy that is. The politicians can have a $200,000 a year pension, but for business owners, if you invest money inside your corporation, we think you should only be able to have $50,000 a year of income, passive income. Passive means you're not working for it, you're investing for it. And once you exceed that 50,000, we are going to hammer you on your active business income. And the rule is basically if you go over 500 or sorry, over 50,000 of passive income, for every dollar you go over, your small business tax deduction drops by $5. So if you went over by $100,000 of passive income, we take 100,000 times 5, that eliminated your full $500,000 small business tax savings. So usually on the first 500,000 of income, you're going to pay roughly 12%. If you didn't have, if you were offside on your passive investment by 100,000, then you wouldn't pay 12%. You'd pay 26 to 29, depending upon your province, from $1. So really got to watch that $50,000 passive income. And when I say it's sneaking up at you, people start saving more and more in their corporation, and they don't think about it because they're earning 10 grand, 20 grand, 30 grand, 40 grand of passive income. But as those assets build up, all of a sudden one year you're going to go, oh, look at that. I made a bunch of money inside my corporation on investments. And then you're going to realize at tax time, you just really hammered your small business tax deduction for your active business.
One thing I just want to tie in there while you're mentioning it, because a lot of people will say, well, I've got my operating company and I am investing in my holding company, right? Where I should be investing. I put my investments and I invest there and all these different things. That's where I'm earning my passive income. Well, there is an association there. So keeping in mind, just because you're investing in your holding corporation, if it has an association to your operating company, which it typically would, because that's where those 88-cent dollars are coming from, that also impacts that small business tax deduction. So keeping that in mind, I think it's really important. And I think with it only coming into play a few years ago, people aren't, like you're saying, they're not experiencing the impacts of it just yet. They've put their money into GICs, things like that. They haven't come up for renewal. Maybe they haven't come up to maturity and they've gotten those returns, and now they're going to get hit with it, and they can't retroactively fix that now, right? So that's why we want to talk about it, and we want to make people aware about it, and just know how we're taxed on those investments that we're putting in our holdcos, right? Typically in our holding corporation, but sometimes in medical corps, your professional corporations, all of those things. These rules are going to apply.
Yeah, we see doctors investing in their operating company, and we see real estate agents like in Ontario and their precs and stuff. But let's go through sort of that 88-cent dollar thing, and then we'll get into the actual each one of these things, how you're taxed. So let's say you're a corporation and you earn $1 that you don't need to spend either on salaries or something, and that dollar you can pay yourself out as a salary, be left with ballpark 50 cents, 50, 60 cents, or you could leave that dollar inside the corporation. If you leave it inside the corporation, as long as your income's under 500,000 in that corp, you're taxed at 10, 11, 12%. We just say 12%. That's the average that's the average across Canada. Each province is slightly different. But that 12%, so let's say, is paid. So then you're left with that dollar. Instead of $1, you have 88 cents. And that's cool. Now we have those 88 cents. Typically, the average person is going to take that money from their operating company and roll it into their holding company, either through a trust or directly to the holdco, and you can talk to your accountant about that. But the bottom line is we ideally would like those 88-cent dollars inside that holding company to get that extra layer of creditor protection, to keep it separate. You might get sued in your operating company. You might go bankrupt. So assuming we put those 88 cents in that holding company, keeping in mind what you just said, Christina, that it's going to go, associated company is going to go back to the operating company if your passive income increases 50%. But let's break down each type of investment we mentioned. So the first one I mentioned was interest income, and that would more like be a high interest savings account or a GIC. So if we have a interest income in a corporation, how are we going to be taxed on that?
Yeah. So in a GIC, we're going to be taxed as interest. So one thing to mention about corporations is that there is no graduated tax rate. You're just at the highest tax rate. So that's the first thing. First things first. We talked about your efficient 88 cent dollars, but when we get over to the investing side, we have to remember that there's no such thing as tax. Like we talked about, there's no such thing as tax-free savings accounts inside your corporation. It is non-registered, and when you are investing in like the non-registered type investments, you're taxed at the highest tax rate out there. No graduate, it ranges provincial, like different provinces have different tax rates for corporations, but they're all up there at 50%. So you're in that highest tax bracket when you're investing in things like high interest savings accounts, GICs, which is a typical investment that a lot of corporate business owners are going to use because it's safe, right? They're not going to worry about it. They can access to their money. But sometimes you're not realizing that, that 4% that we're getting out there right now, really cut that in half, right? Because it's pure interest, it's pure income. You're paying your full tax rate on it. And it is absolutely going to impact that small business tax deduction.
Yeah. So perfect. So GICs, bonds, that's going to be interest taxed at probably over 50%, depending upon your province. There is a little refund there when you pay it out to yourselves, this refundable dividend tax on hand that we won't go into, but ballpark 50% or more. The second one we talked about was capital gains, and we have a lot of individuals buying stocks inside their holding companies or mutual funds. How are capital gains taxed inside the corporation?
Well, they were better until we had a little change not that long ago. That was not great. Yeah, previously people did like those capital gains. They were trying to invest for those capital gains. That was the goal. But we had that increase. So now inside of your corporation, you're taxed at 66%. So 2/3 on that capital gains is what you're going to be taxed on, which is not ideal. It used to be one of those things that people would look for in investing in corporations, is really trying to get the capital gains type investments. But now everybody's kind of rethought that process or rethought that strategy since they made those changes back in June to the capital gains exemption. And corporations, holdcos, they're all taxed highest tax rate, everybody. 66% is what you're going to get taxed on those. Not
Yeah.
ideal.
Well, you'll pay tax on 67% of that.
Sorry.
So
Yes. Yeah.
if you earn a dollar, the old ways, if you earned a dollar, 50 cents could flow out through that capital dividend account, which is the magical account where you can flow out money tax free to the shareholders, and 50% would be taxed at the high tax bracket. So you'd pay roughly, 25, 27, depending upon your province. Now, as of this year, now 2/3 of that, or 67%, is taxed at that higher rate, and only 1/3 comes out of the capital gains. Now, when you invest inside a mutual fund, some of that money is interest income. You might have some bonds in there, and some of it is capital gains. Capital gains is still a lot better than interest income. So, do you want to talk about that corporate class now, Christina, while we're just on those mutual funds? Or you want to save that?
Yeah, we can talk about the corporate class. So, a lot of the mutual fund companies out there that offer these investments said, "Hey, maybe we can do something a little bit more tax efficient for corporate investing," and they have a corporate class type mutual fund. And what that means is, instead of investing in a mutual fund trust, is what you typically be investing in a mutual fund. If you use these corporate class investments, and they're the specific funds that you have to choose, it means that you're actually investing in a share of the corp. It's a mutual fund corporation, which the goal of this is that now that corporation's going to receive the returns from the interest, from the dividends, from the capital gains, all those types, all the different types, like you would in a traditional mutual fund. But then they can distribute it as a capital gain. So they can, sometimes it's dividends, sometimes it's capital gain, but they can more tax efficiently distribute it in that corporate class to you. Another big one, and we haven't really dug into dividends yet, we'll touch on that in a minute, but foreign dividends are taxed highly. There's no dividend credit there. So when you invest in foreign dividends, you're paying full tax on that. That we can get rid of with these corporate class as well, because everything's kind of coming into the corporation, and then you're receiving the capital, that capital gain instead, right? So they've structured these a bit differently to be more tax efficient, which, yeah, definitely definitely helps on the tax side and reduces passive income and whatnot for you as well. So if you're doing a traditional mutual fund, anyways, definitely something to look into.
Yeah, it's pretty cool. You can you could have a mutual fund or you could have a corporate class mutual fund. In the corporate class, you're just going to pay less tax inside your corporation. You can have basically the same investment. So it makes sense to take a look at that. It's not the be all to end all of the number one thing. It's still mutual funds and fees and all that stuff. But if you're going to do it, you'd be better off usually in the corporate class. So Christina, we get a lot of real estate investors. A lot of our clients do private lending. So would private lending, where would that fit?
So private lending is interest, right? You're earning interest. So it's going to be taxed just like the interest that you'd earn in a GIC, fully taxable to the corporation.
Yeah. So you're 15% or 12% in your private lending. You can cut that in half or even less than half, depending upon which province you have. So that's
And
again,
that one you got to be careful of, because that's where I think people can get those higher returns and hit that 50,000 without completely, without meaning to, because you're really only getting half the return, right? Once you pay your tax. So it seems, and those returns can get quite high, but yeah, half of it is taxable and it all creates passive income.
yeah, I mean, you could have what, $400,000 at 15% would be $60,000 a year of passive income.
Done.
Which,
Yeah.
400,000 doesn't sound like a lot for a business owner to have in the corp after 20 or 30 years of working, saving for retirement. So yeah, so that can sneak up to you. Okay, so we talked about interest, we talked about capital gains. The next one was dividends, and dividends are kind of in between interest and capital gains. They're closer to capital gains now than they were prior to the capital gains inclusion change, but dividends, typically, what are we talking about when we're talking about dividends? That's just a corporation or a stock you own paying dividends. What other dividends do we have?
So we had I kind of put through a Canadian eligible dividend is a little bit different. When we talked about shifting money from one corp to the other, that's an intercorporate dividend. So you're not really actually going to be taxed on some of those things. The word dividend comes up. We talk about it in life insurance as well, right? So it's good to kind of determine exactly what we're talking about. The majority of the time when you're investing in stocks and whatnot, though, it's going to be an ineligible dividend, and you're typically going to, it could be Canadian corporations, and that's going to be taxed a little bit better than foreign. So if you're investing in U.S. corporations and receiving dividends, but so you get the refundable tax on the non-eligible Canadian corporations. The foreign corporations that are paying dividends to you, you're going to be taxed as ordinary income. So you're not going to get that advantage of a Canadian dividend on the foreign. And foreign is like US, right? Which a lot of that's, or typically a lot of corporations you're going to be investing in, right?
Yeah. So again, talk to your tax advisor if you're investing in any foreign investment inside your corporation. You just got to be really aware of the different tax rates
Well,
on
yeah,
that.
and maybe learn about that the corporate class, right? Like that's one of the things that they've put together as a strategy for you.
Yeah. And sometimes your income can be treated as more than one. Okay. So we'll get into that in a sec, but let's get into that tax free. We're gonna save the best for last, but on the tax free, sometimes that refers to return of capital. So a return of capital is very common in a real estate transaction where you invest 200,000 in a project and they renovate a building, and then you might get your 200,000 back. You won't be taxed, not necessarily taxed on that if it's counted as a return of capital. So the return of your own money, typically you're not taxed. So sometimes we can have an income that's going to be treated part one way and part another way. One of those examples, Christina, is a REIT, so real estate income trust. Real estate investors like to invest in that. So how typically is a REIT counted as income?
So REITs can have a bit of a mixture, and that's the neat thing about them. So you can start with, sometimes you'll start with a return of capital. Later on, you might be getting some income from it, but that return of capital is not going to be taxed immediately, right? It's return of capital, so you're not paying the taxes on it. It's not going to create passive income, which can be really good in a investing strategy inside your corporation, right? When we're looking for those investments that provide a return of principal, that is a good tax strategy. So a REIT can be good a REIT can work well on that side of things. We've got a bit of a mixture in there.
Yeah, you can really defer the taxes. Like again, not saying this is going to happen, but if you had $100 million you put in there and you're taking $100,000 a year of income, well, in that situation, you could have potentially 10 years of little to no tax. Again, there'd be a combination, but little to no tax. So you're kind of deferring what you're going to pay tax on, down the road till potentially, you've sold your business, you don't have other income coming in, you're not taxed as high. So again, going back to what a corporation can do is really can help you manage the flow of income, manage the flow of taxation. You can pick and choose where your income comes from, where your tax gets paid. Individually, you all that planning is kind of thrown out the window. Um, and just sticking to that tax-free income, return of capital, there's a couple other investments that you can do, but real estate is the one we see the most with the return of capital. Anything kind of real estate correlated, and then Christina, what other investments are we going to talk about here? Because I know we get a lot of real estate investors. So how is real estate treated from a tax perspective? If I buy a rental property inside my holding company, how am I going to pay tax on that rental income coming in?
Yeah, so rental income again is just ordinary income. So you do get taxed at that highest tax rate for it. Now, as a, real estate investing, typically you're not going to be taking all of that income. We're going to be offsetting it with expenses with real estate. That's the beauty of having real estate is you typically have those expenses that are going to offset it. So in the early years, what's going to happen is the majority of the time, you're going to end up, taking the cash flow, receiving that rental income, the expenses are outweighing that rental income. Maybe down the road, you might take a refinance. Well, we know that refis are tax free. It's a loan, right? So you're not going to pay tax on that. And then the other thing down the road, when you want to, maybe those properties are paid off, maybe you didn't do a refi and you're still getting that income, you don't have to worry about the small business tax deduction, the small business deduction grind once you've sold your operating company. So that is only, we worry about it definitely when we're creating active income and we're in those years where we're saving for retirement and we're building up our assets and stuff. We don't want to lose that. But when you don't actually have an active business anymore, so maybe you sold off your business, that active portion, you now have just your holding company, you don't have to worry as much. Well, you don't have to worry at all because you don't have that small business tax deduction to worry about, right? You're not getting that active income anymore. So something to think about with all of these investments, really. But rental real estate kind of makes sense because you're saying, oh, you're telling me that I'm never going to be able to take that cash flow, which I intended to use in retirement. Well, the cash flow, if we don't have the expenses to offset it later and we actually are taking it, not going to impact, you're going to pay tax on it, absolutely, but you're not going to have that small business deduction grind, that small business tax deduction grind.
Excellent point, Christina. And again, rental real estate. We talked about that return of capital. A lot of refinancing done on rental real estate too. Right? I got a fourplex and I want to refinance it. I can refinance another $200,000 loan and not pay tax on that. So Bitcoin is another one that we got the clients invested in Bitcoin. When you invest inside Bitcoin in your corporation, Bitcoin's considered capital property. Capital property meaning capital gains, right? So if you invest Bitcoin or invest in Bitcoin inside your corp, you can, if you earn $100, 67 of those dollars will be included in your income, probably at the top tax bracket, and 1/3 of that will not be included. And that 1/3, just like a stock, just like selling a piece of real estate, that 1/3 can flow through that magical capital dividend account to the shareholder completely tax free. So anytime we can get money out of that capital dividend account tax free, we're going to take it. But the Bitcoin is a real interesting one now with this passive income grind. So if you make more than $50,000, well, now of income, you're going to be taxed at that highest rate. So we've got people that invested in Bitcoin when Bitcoin was relatively low compared to where it is now. If you threw a couple 100,000 as a business owner into Bitcoin a year ago, well, guess what? If you sell that Bitcoin now, you're probably going to have, say, a $200,000 or $300,000 gain. 2/3 of that will be included, so 200,000 is included. You're only allowed 50,000. You just made $200,000 of passive income. You're going to eliminate your small business tax deduction for your active corp to zero. So if you have Bitcoin inside your corporation, check with your accountant before you go selling anyone to see the tax implications and if it's going to affect your active business income. That 12% on the first 500,000 could be eliminated if you make too much. So again, there's strategies on how to get that out personally down the road and loans and stuff. We're not going to get into any of that stuff today. Talk to your accountants. But Bitcoin, be careful when you sell it, because if you got a big gain, it could really affect your small business tax deduction. And I just want to say just one more thing on that. We talked about why you should incorporate selling your corporation. So in Canada now, it's about 1.25 million if you sell a qualified small business. Okay, a qualified small business, to be qualified, there's a couple of rules. Talk to your accountant, but the big one is 90% of the money is going to be used for active business income. So if you're going to sell that active corporation and you have all kinds of passive investments in there, you're not going to qualify for that $1.25 million tax free. So that's why people are rolling that money into their holdco. So you sell your small business, you start it from zero, you sell it for 1.25, you're not going to pay any tax on that if you qualify for it. Sometimes you can multiply that through family members if there's a trust. Talk to your accountant and lawyer about that. But that's huge. But that, going back to that capital dividend account, we love the capital dividend account. We love avoiding taxation and all these things. And that kind of brings us to the last one, Christina. Is there a strategy that we can avoid the interest income, avoid the capital gains income, avoid the dividend income, avoid the passive investment grind, avoid the 67% inclusion, and get all that money to come out of the capital dividend account completely tax-free down the road?
It seems too good to be true when you put it like that, Darren, but it is my favorite strategy of them all. When it comes to the corporate strategies, corporate life insurance, definitely it checks all those boxes, which is crazy when you say it out loud. But if we go through each of these things individually, it absolutely does check those boxes, right? Like with corporate life insurance, and we talk about infinite banking a lot, right? But set infinite banking aside, we could still use this exact same product for infinite banking, mind you. But just looking at corporate owned life insurance as a tax strategy for corporate business owners is huge. It's it's the only thing we got left. Like when you look and we go through all of these different investments, they don't check the boxes. Like if we start, the first thing is we obviously get to use our 88-cent dollars just like we do with the other investments, right? So we're at par there with being able to use it. But once we get that money in there, that cash value, that growth is all going to be tax free. We keep it inside of the policy. It grows tax free. It does not create passive income. It is the only one on this list that we've talked about so far that does not create passive income inside of your corporation. You don't have to worry about that grind with it, and you're not going to pay those tax rates on that growth, which I think is pretty huge in itself, that we have that inside of this product.
It is literally mind blowing. Like when everything else we had was basically stripped away in the last 7-8 years on what business owners could do. And I mean, obviously, Christina, we're biased. We're in the industry, but I'm amazed now at the major accounting firms, the major firms and financial institutions of Canada that are saying to people, this is it. This is the greatest tax strategy we have now. Like you can pay that small 12% business tax and then grow it for the next 40 years tax free, get loans and use it for the next 40 years tax free, potentially retire using loans personally tax free, and then not affect never get a tax slip. Like there's no tax slip to worry about your passive income grind, because there's not even a tax slip associated with this. It grows completely tax free. And then let's say you die and it's a 2 million, 3 million, $5 million tax benefit. Well, you get all this money gets paid tax free to your corporation. Depending when you die, you could have that full, say, $3 or $5 million flow out to your family completely tax free. Not like, again, depending when you die, most or all of it will come out tax free. But picture like $3-5 million at the end of your death coming out to your family tax free. Like you grew it for 40 years, you added the death benefit, and it all comes out tax free at the end. So your family can keep the business, keep the real estate, keep the home, keep the lifestyle they become accustomed to, have money for the next generation, have money for charity. It is literally the most incredible tax investment strategy business owners have today in Canada.
Absolutely. And just to dig in a little bit on the other investments that we talked about today, because I talked about how much I love the no tax on growth, but that death benefit part's huge. So when we talked about those other investments, there's no estate planning component to them, right? You die and you have those investments inside your corporation. Your family has to get, or who your family, your shareholder, they have to get that. If they need to get that money out, they're going to pay their tax rate in order to get that out. It's not like you die, all that tax goes away. It's like, no, they still need to get those assets out of that corporation, and they're going to pay tax. They're going to be left with about half, right? Half of your assets are now CRAs if your family needs to get those out on your death, right? When we use the life insurance policy, those proceeds paid tax free to the corporation, and your family members can flow it out tax free. Like, again, that is a huge thing just on its own. Like, I've got clients that have money in their holdcos, and they're going to have it there on the day they die, right? They got a lot of money. It's going to be there the day they die. They know it. Why not shift that into a life insurance policy so that it pays to their family instead of CRA? Why not? Why would you, like, for no reason would you not want to do that, right? Like, the death benefit and that estate planning part's huge too on the tax side of things. And then from the retirement planning side of things, to be able to access your cash, we've got lots of strategies on that, how corporate business owners can now very tax efficiently access these funds through different strategies and plans. Like, we've got that full podcast on the corporate insured retirement plan. If you haven't listened to that, go back and take a listen, because we dig into all of this stuff, right? We got lots of podcasts that dig into it more. But the huge thing is that the tax savings are there. We can get rid of 3 layers of tax that we would have paid otherwise in using the other strategies, which really does make it my favorite, right? Absolutely.
Yeah. And I mean, if you don't have life insurance, if you have $1 million and you have $1 million inside your corporation and die, and let's say you have some rock star accountant, and instead of 50%, you pay 30 or 35% to get it out. Okay. But that $1 million could have been a $3 to $5 million death benefit, and all of it come out tax free.
True.
So again, we can get into the exact amount that comes out depending upon your situation, what kind of income and what all that. But at the end of the day, there's absolutely nothing that comes anywhere close to corporate owned life insurance structured the proper way.
True. And from an and side of things, it's not that you just have to pick this strategy either, right? We always talk about that this is your and asset. So the goal is to put your corporate savings in here, a safe spot for you to be able to save. But you can still utilize that and asset component, right? We can access 90% of those cash values at any time. So it's not to say that you're not going to use, and we want you to know how all of these other investments are taxed as well, because the goal is to get right back into those other investments, right? You want to get into real estate, you want to do the REITs, you want to do you want to do Bitcoin, anything. It doesn't just stop with the life insurance. It starts. That's where it starts, right? That's where we start, and then you can branch out into those others.
I love that, Christina. I've used loans throughout my business life to invest back in my business, into real estate, into Bitcoin, into hard assets, into private lending. You're right. You're bang on there. It's truly an and asset, plus all those other tax advantages we talked about, plus the capital dividend account at death, plus the guaranteed not to go down, guaranteed to go up every year. I guess we could go on for another hour talking about the benefits of it. But if you have a corporation and you're interested in learning about how this corporate life insurance can benefit you, please reach out to us. Arrange for a free education call with one of our coaches, and we can walk you through the details. But if you're a business owner and you have cash or investments inside your corp, you need to learn about corporate-owned life insurance. All right. Thanks for watching. Thanks for listening. Hope you enjoyed this one. Take care.
Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.